So let's talk about shares. What are shares? Imagine you walk into a restaurant and instead of ordering for food or buying a meal, you buy a part of that restaurant. So whenever the restaurant makes profit, you have a part of that profit. That is what shares are. Shares are part ownership of a company. Okay? Shares are part ownership of a company. So when you buy MTN shares, you become a part owner of MTN. Isn't that incredible? Yeah, it is. So how does investors, how do they make money from buying shares? Okay, you make money using two ways actually. First is by receiving dividend, and secondly is by price appreciation. What is dividend? Dividend refers to the part of profit that a company gives to its investor. Let's say you bought Zenith Bank shares, and at the end of the accounting year, Zenith Bank makes profit and decides to share that profit to all those that invested in their company. If you think about it, when you invest in a company, you are actually giving them your money to run their business. So it's actually okay, it's actually best practice that they return part of the profit back to you for investing in their company. So that's what dividend is, and that is the first way you make your money. The second way you make your money is by price appreciation. Now, let's take for instance a normal trader. How does a normal trader makes his money? Let's say you go to the market and you bought your item of trade for, let's say, for 500 naira from the wholesaler, and when you bring it back and you are retailing it, you will not actually sell it at that same price, right? You will sell it at a price that is higher, and that's how you make your profit. Let's say you now sell it for 600 naira, your profit now becomes 100 naira. That is what price appreciation is. When you buy shares, you buy at a certain price. So you allow the shares to increase in price. A lot of things will cause share price to increase. I'll talk about it briefly. First of all is the forces of market demand and supply. You find out that when people are buying more of that shares, you see that the prices would actually rise. Okay, so another thing that can actually affect the rise of share price can be the government policy and a whole lot of factors, the management of the company's policy. Those are internal and external factors that can affect price. So when you buy your share at a particular price, you allow it appreciate, you allow it increase in price over time, and then you now discover that it's now sold for a higher price. Then you can now sell it at that higher price and get the profit out of that price. So those are the two ways you earn money when you invest in shares. First of all, the company pays you dividend if it's a dividend paying company, and also price appreciation when the price of that share increases and then you later sell it. So let's talk about something else, and that is something very, very important, which is risks and reward. Investment, as you know it, is something that has risks in it. There is no investment without risks. So let's talk about the risks that are involved in buying or investing in shares. Remember what I told you what shares are? I said they are part ownership of a company. It means you are part owner. You are a part owner of that company you are buying their shares. So let's take for instance, there is a possibility that instead of this company making profit, it can actually make loss, right? Of course it can. Now, when the company makes loss, there's no profit to share. And that means you are not getting any return for your investment. That is one of the risks that are involved in buying of shares. Another risk attached to investment of shares is a possibility that the share price can go down. The share price can depreciate instead of appreciate. Yeah, that can happen. There's a possibility that you bought a particular share at a certain price, and then in the next 6 months, and then the next 3 months, the share price, instead of increasing, has reduced. Yeah, that can happen. So these are the risks involved. So in order for you to make sure that this is not the situation, you need to make what we call analysis, company analysis, before you buy your shares. You don't just wake up one morning and decide, okay, I'm going to buy this shares, I'm going to buy these shares. No, you try to make sure that you make analysis to know how profitable these people have been in the past, how profitable they are, and what is the prospectus. What are they looking at achieving? What is going to be their achievement in the coming years, before you now determine that, to know, okay, this is a share, this is something I'm supposed to buy. Understanding the risks involved will make you a better investor. Okay, so you need to analyze each company to know how profitable they are in order to mitigate these risks. And so that is it. Shares are part ownership of a company. You gain by receiving dividend or price appreciation. But you must keep in mind that you need to do proper research before going into buying any share. Or you can listen to recommendation by experts. It's all the same. So that is an overview of what shares are and how you can make money from them.